Hello everyone, welcome to Demand Supply Trading Practical Session number 32 for the year 2024. Myself Srijit Kakkar. Today is Sunday 18th of August 2024, and before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So we recently started with the WhatsApp channel, and if you wish to join that channel, you can scan this QR code. Otherwise, the direct link is also available in the description. Now, this channel is where we keep you guys updated regarding our upcoming sessions. If we have any videos coming up, or if we have any promotions coming up, that is where we update you. So just in case you are interested in joining the session, you have the QR code. You also have the direct link in the description. Now, talking about today's session, it's practical application of demand supply methodology. So our demand supply course used to be a paid course. Now it is available absolutely free. So you can go through the complete course content. Theoretically, you can learn the methodology. The links are available in the description. So once you go through the course content, you will be learning the methodology theoretically, right? What is demand supply, how these zones are identified, how do we qualify them, right? So all the nuances which are uh, connected with demand supply methodology has been covered theoretically in that um, course. Now, what happens is once you have gone through the course theoretically, unless and until you see some practical examples, you don't get very good understanding of how to apply the complete methodology. And plus, what happens is when you're going through theory, the examples that are taken are more like, I'll say, textbook examples. But when you get into the real world, at times things are not textbook examples. There might be variations, and that is what these practical sessions they also help you with, that if there are some variations, how to handle those variations, how to plan trades. So the more number of sessions you'll be attending, you'll be having better clarity to how to handle different situations. Okay, now coming back to these practical sessions, I do these sessions once every weekend. And like I said, if you're joining that WhatsApp channel, that is where we update you when these sessions are happening. But I'll definitely like to add that next weekend I'm not available, due to which we'll not be having a session next weekend. So just in case you people, especially, take out time and be available during these sessions. So if you want to plan something for the next weekend, you can do it as if from today, because you know that I'll not be available, so you don't have to block your time for this session. So I just wanted to update you guys regarding the next weekend. All right, now coming back to these practical sessions. So like I said, the theory part is covered in our lessons, but in these practical sessions, I'll take some examples. Now, the beauty of demand supply methodology is that we can pre-plan the areas where we would like to be buyers and sellers. So in these practical sessions, I'm not picking something which has already happened and then we are just back testing it, or we are just doing a walkthrough of it. We are basically planning something for the future, right, which nobody knows what is going to happen. And that is the beauty of these sessions, that you see the magic of demand and supply, the way it works, right? It's not that something has already happened and I'm just randomly picking any symbol and maybe applying some indicators and just walking you through it. So we're not doing that. We are planning for the future, and that also helps you build confidence in the methodology. Obviously, every trade will not work, but yes, you will see as you look at more and more examples that the trades that work for you, the reward to risk ratios are really, really nice and beautiful. And the ones which don't work for you, we have a predefined risk management rule, and we don't lose more than what we are willing to lose on that particular trade. And that is what keeps you on the positive side, which is good reward to risk ratios. So the better the reward to risk ratios, the more number of times you can be wrong, but you can still be a net profitable trader. All right, so before we start with today's example, we do have one example which was getting carried forward. So we'll start with the again doing the review of it, how that trade is progressing. And we also have two more examples which got triggered during the week, right? So we'll also be looking into it. So let's get started with the one which was getting carried forward. So this was our session number 30. So session number 30, we did the analysis for this, and we also talked about the very next day you got a move which was about 3:1. Now it has been hanging around in this area. But we talked about that even if you're looking for a tested area as your target, you still have about 5:1. And as of now, the best thing could have been done is at 1:1, we can make it as a break-even trade. So if you made it as a break-even trade, you're still in the trade because it has not gone back to your entry price. So it will still remain as an open trade. We haven't got the opportunity to trail onto it. We even didn't get the opportunity to exit it at our target one, which is definitely a tested zone, but was showing about 5:1. So it still remains as an open trade, and we'll keep tracking it unless and until we get exit on this. Now, the other two trades which got triggered in this week, right? So just give me a second. Let me bring that up. So the very first one is this one. Just a second. All right, so this was our session number 25. The session was on the 30th of June, and the prices came back into the zone on the 13th of August. This was a type 2, type 3 trade for us. Now, what do we do in a type 2, type 3 trade? We wait for the prices to come inside of the zone, then we wait for a bullish or a very bullish candle to form, and after which we participate. Now, if I go to my refining time frame, which is the hourly, you can see that after the prices came into the zone, the very next candle is definitely a bullish candle, which is this one. So you did have the trigger to participate in this trade, provided you had the good reward to risk ratio. Let's also see how was the reward to risk ratio when the prices were coming back. So you can see when the prices were coming back, this would still be a live candle, right? So as long as the candle is live, the zone is not yet completed. Only after the completion of the candle, after the candle closes, you will have this formation of the zone. By the time the zone was already violated, so we'll mark it as a stopped out trade. So that's your session number 25, which proved to be a stopped out trade. Was definitely type 2, type 3. We did have the opportunity to trade it as a type 2 or a type 3 trade. Now moving to the last example which got triggered. Give me a second again. So the last one which got triggered is the one that we analyzed the previous session. Give me a second. Let's get it back. Perfect. So this was session number 31, which was on the 11th of August. And the prices came into the zone again on the 14th of August, which is this day. Now, the problem here is that by the time prices came into the zone, we already had an opposing zone, which is this drop base drop. And now this is only showing us a reward to risk ratio that is about maybe 0.5. So as a rule-based trader, we do not take trades where the reward to risk ratios are anything less than 2:1. So based on reward to risk ratio, this would get disqualified for us. But yes, if you would have taken the trade for that small little target, you would have got your target in about a day. But the problem here is we are not even at the best location, because if we were at the best location, we could have even taken the target from the intermediate time frame. So you can see we were planning low on the curve. We were not very low on the curve. So which is where the reward to risk ratio was something which would have made us avoid this trade. But otherwise, yes, we came into the zone, touched the zone, already got a bounce all the way to the target which the chart was showing us. And that target was not good enough for us to plan a trade, because it's only showing us 0.5 and we need at least 2:1. Alright, so that takes care of some of these examples which were getting carried forward, plus also the one which got triggered during the week. Now, talking about today's example, I would like to add what happened actually today is that, I'm pretty sure all of you know that I do these sessions in both the languages, English as well as in Hindi. So when I was doing the Hindi session today, after starting the session, I realized I did not pick anything for today's session, right, as an example to share. I mean, I did pick, but I did not put it in my list, right? So I was almost blank at that time, which was the symbol which I wanted to share. So I had to randomly pick something. So it's not I'll say the best example we are taking today, but my hands were tied. I just started with the session, and then I realized I didn't note down which symbol I want to analyze today. So wherever I could quickly identify, I just picked that up, and that is what we analyzed. Otherwise, I could have definitely picked a better example. But here also we have few things to learn. So not a very bad example. It's still acceptable. But yes, I could have definitely, definitely identified something better. If I wouldn't have forgot, noting down that, the name of the symbol. So anyways, let's get started. So yes, when it comes to trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. The link is available in the description. So during the session, if I talk about some videos, if I talk about some documents, all the links are available in the description. So not to worry, where do you find them? Just go to the description and you'll be able to locate those videos or those documents, because the links are right there available to you. So yes, we need to be mechanical and rule based, and that video will help you understand why you need to be mechanical and rule based and what process you should be following. That has also be explained in that video. Now you might have to go through that process maybe twice, maybe thrice, but there is no bypassing it. Eventually everyone has to go through that process. So the sooner you start, the better it is going to be for you. And now, since we need to be mechanical and rule based, now what happens is if you are starting, if you've just started learning trading, or even if you've started learning demand supply methodology, so what happens is you're lacking the experience. And when you're lacking the experience, it's not easy to create a trade plan. You can only create a trade plan for yourself once you have good enough experience of that particular methodology. And to overcome this challenge, I have created a ready-made trade plan for you, which is basically a combination of two documents. The first one is your trade plan steps, which we can also call as the flow chart or the walkthrough. This guides you what you need to do as a demand and supply trader step by step. Now, every step has its own elaborate rule, and those rules are available in the rule book. Now, this rule book that I'm sharing with you is a conservative approach. With time, with experience, if you want to make some modifications to it, that can be done. Nothing wrong with that, because everyone has a different personality style. No two people are same, and everyone is trading for different reasons. Some people want to do intraday trading, some people want to do swing trading, some people want to do it more like investing. So yes, based on your experience, based on your needs, the rule book can be modified to make it conservative, to make it extra conservative, to make it aggressive, to make it super aggressive, right? It's your call how you want to modify, but at least you do have a starting point to help you start planning your trades. So what is my step number one whenever we start planning our trades? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why do we start with the trade purpose as a step number one? And the reason for that is when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge that we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again follow a logical process, and that logical approach is that the longer I want the duration for the trade, the bigger the time frame I will be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. And that is why this becomes as our step number one. We first define our trade purpose, because based on our trade purpose, we'll be selecting our time frames. Now, what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days. But if you're trading markets which are not 24-hour markets, then I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they gap up, some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, we have that gap risk involved, which we would like to avoid initially, because when we are learning something new, you don't have expertise from day one. You can make mistakes with your analysis. So we don't want to take that unnecessary overnight gap risk. And that is why my recommendation is initially hourly dailies are strictly intraday trades. Now for weekly monthlies, anyhow, we are not expecting to get the exit the same day. So here you have no choice. You'll have to keep these positions as overnight positions. But that does not mean that you cannot have a gap against you when you're planning weekly monthlies, right? You can still have a gap against you, but the probability definitely reduces. One, because you're using bigger time frames, and two, since you're using bigger time frames, at times the zones are also pretty wide, which can absorb, if you get a gap against you, price might not gap beyond your zone. It might go maybe a little deeper into the zone, which is where uh, the probability definitely reduces. But yes, you can still have gaps against you even for weeklies and monthlies. But as you start having more and more experience, if you want to include daily incomes into overnight trades, that can also be done. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade from the rule book, I'll get to know what time frames I should be using. So if you go to your rule book page number 28, we start with the topic, which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question is, what will be my time frames for all these 4 different trade purposes? And we get the answer from this table. Now the table which is available on page number 31 is specifically for NSE market, which is only open for about 6 hours 15 minutes during the day. But when you're trading markets which are open for longer duration, then you can refer to the page 32, where you have another table which can be applied for commodities, forex, cryptocurrencies, or maybe even if you're trading some stock markets which are open for longer durations, you can refer to this page. Now coming back to, because I'll be taking example from the NSE India market, so I'll be referring to this table. And since I opted, I want to plan monthly income trades. From this table, I got to know that my time frames as a monthly income trader will be monthly, weekly, daily, 60. Monthly is the higher time frame used for curve analysis. Weekly is the intermediate used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but on the NSE exchange, I have over 2000 companies listed. So humanly not possible that I sit and analyze 2000 stocks every day. So what I need now is a process for selecting scripts, that out of these 2000 companies, I select a smaller list, because if I have a small list, I can do my analysis almost every other day. But if I have to analyze 2000 plus companies every day, it's not an easy task. So how do I get a smaller list? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they work is that we input certain conditions into them. These are the conditions I'm looking for. And then those computer programs, they identify that out of these n number of symbols, which symbols are matching with those conditions. Whatever is matching, it gets shortlisted for us, and that is how we get a smaller list. Now, very important thing which you need to remember, no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks, right? Or those symbols. So the scanner never tells you what you need to buy or sell. The scanner only helps you get a smaller list out of a bigger list. Now, once you have that small list, you will have to analyze all of them one by one individually. And out of this, whatever is in sync with your trade plan, that might be your trading opportunity. Whatever doesn't match with your trade plan, you simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages. They can help you shortlist some symbols. Second example, on my YouTube channel, search for scanner. You'll be able to find few videos, different scanners, different logics, which can again help you in shortlisting symbols. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, you can search for top-down analysis. You'll also be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners. Let's look at few of them before we move ahead. So like I was talking about, that once you go to our website, under the free tab, you have stock screener. Because I opted, I want to plan MIT trades, I can run the long scan and the short scan. Now, like I already said, whatever results you're getting, like you can see here for the long scan, it is giving me about 10 symbols. Does not mean I will blindly buy these 10. So what the scanner basically did was, out of 2000 plus symbols, it gave me a list of 10 symbols. And if I look at the short scan, it is giving me none. So out of 2000, now I have a total of 10 symbols to analyze. Out of these 10, if anything matches with my trade plan, I have an opportunity. If nothing matches with my trade plan, I don't have any opportunity. So always remember, you can never blindly buy, sell, whatever the scanner is shortlisting for you. The job of the scanner is only to give you a smaller list. You will have to check out of these what matches with your trade plan. Now, many times what can happen is the list can be a very small list, like you can see today, or maybe the scanner is not generating any results because nothing is matching with these conditions. Or even otherwise, if you wish that my list should be a little bigger, because the bigger the list, the higher is the probability you might find something which is in sync with your trade plan. So if you want a bigger list, what you can do is you can see that in this scanner I have given 5 different conditions. You'll disable the third one, you'll run the scan again, and I'll do exactly the same thing here. Disable the third one and run the scan again. And now you can see that initially it was only giving me a list of 10 symbols, but now it is giving me 141 from the long scan, and it is giving me 4 from the short scan. So I have about 145, which is I'll say not a very small list, but still a small list, which can easily be analyzed, I'll say probably in 45 minutes to maybe an hour. But if you feel that this list is still big and you further want to filter it out, you can use different filters. Example, I can say only want the ones which get traded in futures, and now you can see my list is down to around 42 from 141. So this is how you can apply different filters to have different sizes of the list. Plus that this is not the only screener available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis, some are your top left, then you have your candlestick patterns, then you have range breakouts, you have your bullish scan, you have your bearish scan, you have your intraday bearish, intraday bullish, crossovers. So you have a number of scanners, screeners available to you, and this is just example of one simple website. If you do a Google search, you'll be able to find a number of websites, a number of scanners, screeners, whatever you feel is the right fit for you. That is the one you can use. And in this example, you saw we got a list of about 145 symbols. Now, once you start analyzing them, there are a few challenges which you will face. Challenge number one, what you'll realize is that out of these symbols which you get, a majority of the symbols, they don't have any quality demand zones or supply zones on the lower time frame. And the reason for that is whatever scanners we just talked about, those 150,000 plus scanners, none of them are based on demand supply, right? They're all based on either conventional technical analysis or fundamental analysis. And that is the reason, just because something is getting shortlisted does not guarantee that you'll have a quality area available to you. So you will be wasting a lot of time analyzing such symbols where nothing quality is available. Now, few of the symbols which might have quality areas, those areas might also be really far away from the current market price. So what is going to happen? You'll have a longer waiting period before the prices are back. And during that waiting period, whatever price action develops, it might even disqualify the trade setup by the time it is back into your zone. So these are some challenges we face when we are using scanner screeners that are not based on demand supply. And to overcome these challenges, I've also created two custom built tools. One is called as the alerts, the other one is the screener. The link to the walkthrough videos are available in the description. You can go through those videos to understand them better. But just to show you an example of these, let's quickly look into it. Now, what alerts basically does is that during the live market, as in when you have formation of demand and supply areas, it notifies you. So it's working real time. So we do have some demo channels available. So I'm showing you example from the NSE demo channel. So you can see on the 16th of August, we give you alerts for about half an hour. So from 11:15 to 11:45, we give you alerts. So here you can see as in when the zones are getting formed, you keep getting these notifications. So it is telling you on which symbol what zone has formed, on which time frame, what is the proximal value, what is the distal value. Now, these are some alerts which we provide from our end. On top of that, you can also place your custom alerts on TradingView, on any market, on any symbol. Definitely the limitations will apply depending upon whether you have a free account with TradingView or whether you have a paid account with TradingView. But this is what alerts they do. Again, it's not a call giving or a tip giving service. It is just helping you identify symbols where during the live market in real time you have formation of demand and supply areas. Now, as soon as you get to know on which symbol we have a formation of a demand zone, on which time frame we have a formation of a demand zone or a supply zone, you'll have to go to that time frame. You'll have to qualify that zone with your trade plan. If it qualifies, it might be an opportunity for you. The other one is the screener. Now, what screener basically does is that I can give my list of symbols. Like here you can see I've given a list of about 40 symbols, and then I'm telling the screener out of these 40, shortlist the ones where the current candle is within 1% proximity to a demand area or a supply area, which means we are almost about to enter the zone. So now I won't have a longer waiting period. Plus, this is not just based on the zones which are getting formed today. The zone could have formed today, it could have formed yesterday, a week ago, a month ago, a year ago, 10 years ago. Doesn't make any difference, right? So for alerts, it is based on the zones which are getting formed during the live market. But with the screener, irrespective whenever the zone was formed, whenever the current candle is getting closer to those areas based on your proximity settings, it will get shortlisted for you. Now, example, if I go to Grasim, you will see that on Grasim I will be having a demand area which I'll be close to, or maybe on the current candle will be having a formation of a demand zone, and that is what you can see. We have this drop based rally, and that is why Grasim got shortlisted for me. So can you see, out of 40 symbols, now I only need to analyze 1, 2, 3, 4, 5, 6, because I know these are the only 6 which are getting closer to demand areas or supply areas, which saves me a lot of time. Plus, I'm only analyzing the ones where I know I'm closer to those areas, I'm not very far away. And plus, once you have created this, you don't have to change it. If you want to look at a different time frame, all I need to do is, if I change it to weekly, the settings, they still remain the same. Now it will give me the results based on the weekly time frame. So example, now it is telling me these are the 3 symbols where on the weekly I'm closer to demand areas. So let's take the very first one, WIPRO, Wipro. So you'll see on Wipro, I'll be closer to a weekly demand zone, or will be having a formation of a weekly demand zone on the current candle. Can you see? In fact, we also looked into it the previous session, and I think even the previous session, because that is also where we were getting closer to it. And now you can see we came into that demand area. From that demand area, we have already started moving up. Anyways, so those are the 2 options that are available if you want to shortlist your symbols based on demand supply zones. Just give me a second, please. So choice is yours, how you want to get that smallest. I showed you a number of scanner screeners which are absolutely free. I showed you 2 which are definitely subscription based. The process can also be as simple as, I don't want to use any of these scanner screeners. I will only be analyzing my Nifty 50 stocks. So now my list is restricted to only 50 symbols. Or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours, how you want to get that small list. Definitely, the more the process is in sync with demand supply, the higher is the probability you might be able to find something which is in sync with your trade plan without wasting a lot of time. But yes, you'll have to choose what is the best fit for you. Now, once you have shortlisted your symbols, you'll have to analyze each and every one of them one by one. Whatever matches with your trade plan is an opportunity. Whatever doesn't match with your trade plan, you simply skip it. So let's assume the very first one in this list was ABC. So what am I supposed to do now? I need to go to the lower time frame. And the question here is, what is my lower time frame? We got the answer from our step number 1. As a monthly income trader, my time frames were monthly, weekly, daily, and 60, out of which daily was my lower time frame. So now I need to go to the daily time frame and identify zone. By zone, we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. Now what I've done is, let's assume this was the symbol, and I have my demand supply zone indicator applied on the chart, where now I don't have to identify the zones. The indicator does it automatically for me, also plots the zone for me. But whenever we talk about demand supply methodology, I always say demand supply is a price action based action. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only 2 things. It can either move up or move down. But when it is moving in a narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when your eyes are not trained to identify these structures, we start with a concept which is called as boring exciting, because what you'll realize is that most of the zones can be identified based on boring exciting technique. Again, I'm saying most of the zones, I'm not saying every zone. So it becomes as a good starting point to start training your eyes. If you want to use some indicators which are absolutely free, because I've made these indicators absolutely free indicators, you can use them for free forever. But once your eyes are trained, you'll have to switch to price action and pay more attention to what price action is telling you versus the boring exciting technique. And the demand supply zone indicator is based on price action. It is not based on boring exciting technique. And we also have the demo version available for the demand and supply zone indicators. If you'll go to the indicator section on TradingView and search for demo demand supply zone indicator, you'll be able to find it. You can try it out. And the boring candle indicator anyhow is a free indicator. You can use it for free forever. Similarly, we also have an explosive move indicator, which can also be used to identify explosive candles, and it is available for free, and you can use it for free forever. Now, going back to identifying zones, you can see the indicator is telling me that this is where I have my nearest demand area, which is a drop based rally. So let's start with this one. and then I'll talk about why did I shift to the lower one. So yes, we have a drop based rally zone available. The indicator has already identified for us. Now, just because you have a zone on the chart does not mean you can blindly trade it, and that is something I talk about every other practical session, that yes, there can be a number of demand areas, there can be a number of supply areas, but the question is that demand or is that supply qualified for me to be used as an opportunity? And how do we qualify it? For qualification, we have a two-step process. In step one, we'll qualify it based on certain conditions, and in step two, we'll qualify based on the booster scoring. So the very first one we'll check is this zone a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone is dividing into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone, which is called as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And as a monthly income trader, our intermediate time frame zone is weekly, and on the weekly you can see we do have an area which is right here, and let's mark it with a different color so that we can differentiate between the two. Now the one in green is my lower time frame zone, the one in pink is my intermediate time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, but partially, right? But to be a case of coinciding level, it doesn't have to be partially inside, it has to be completely inside. And since it is not completely inside, we cannot call it as a coinciding level. So it is not a coinciding level, it's a standalone level. So that's your very first condition. It's not a case of level on top of level. Now, is this zone because of a gap? The answer is yes. You can see that we were moving down. This is a red color candle. This is where we closed. Then we got a gap up, and this is where we gapped up from. So we still have a very small little gap which is not yet filled. And before the gap, if you look into it, can you see for the last few days we were definitely moving down, after which we got a gap up. So if I want to put it under the category of a pro gap, I can even do that. And that is where, if you talk about the next rule, which is your pivot non-authenticity, that will also not be applicable. Even though it is a drop based rally, why it will not be applicable? Because in the rule book you can see I have given you that in case of pro gaps, we can skip the rule of pivot and non-authenticity, because being a pro gap by default adds that extra probability we are looking for, and it is not a case of unstable equilibrium. So the fact is, if you go with all these conditions, the very first zone, which is right here, is qualified for us. Now, if you remember, we did a analysis about maybe last week or maybe last to last week, where again we did have a qualified area for us, but I didn't select it. I moved to the next one, and the reason why I moved to the next one is because, let's move to this one, make it as a demand area, is because first, this is a coinciding level which adds that extra probability. You can see this is also my weekly zone, and I have said this many times that I like to be a little conservative trader, and because I like to be a little conservative, I would prefer to go with a higher time frame zone when the two zones are pretty close by, versus going with the lower time frame zone. Plus, the main reason behind why I would like to shift to the lower one is, can you see, if I try to look for an area of support and resistance, you can see this zone which was formed right here. uh, you can see in the past it has acted like resistance, acted like support, acting like resistance, acting like support, acting like resistance, and almost exactly that is where we have the formation of the zone, which basically will not make this zone work like a trap. The lower zone has a higher probability of working like a trap, and that is why I'm not very interested in this. I'm more interested in this. Now, even though the zone above can be utilized if you wish to, but me being a little on the conservative side, I would prefer to go for the lower zone. Multiple reasons. Reason number one, the lower zone is a coinciding zone with the intermediate time frame, which increases the probability. Plus, the upper one might not work like a trap. The lower one can work like a trap. Yes, I might miss my opportunity. Prices might come here and then start moving up, and it might never come to this area. but I'm okay with missing a trade. But if I'm planning my trades, I like to be very conservative, and that is the reason I would prefer to go for the lower one. But yes, if you want to use the upper one, nothing wrong with that. It is still valid. It's just that the lower one has a little higher probability, due to which I would prefer to go with the lower one. Now, another thing which I would also like to add here is that if you look into this zone, you can see the indicator is also marking this candle as a leg out candle, and marking it as a follow through pattern. Now, when the indicator is identifying zones for us, you can see that it is identifying based on the current candle versus what has happened in the past, because it doesn't know what will happen in the future. So based on the past, the indicator understands that the size of this candle is probably the size of the average candle size, or maybe a little bigger than that, due to which it can take it as the very first leg out. But the very next candle was now an extreme size, and now it becomes as a follow through pattern. So always remember, whenever you're using these indicators, they are not your decision making tools, they are your support tools, right? So even though the indicator is telling me that I can take it as a leg in and a basing, and these two candles are my leg outs, I would still stick with taking both these candles as a basing, right? So I'm taking both the candles as a basing. If I want, yes, I can even push my entry a little higher by using the high of this candle, but I'm just still sticking to it, because I know by the time I draw my entry and the stop losses, I'll definitely be a little above it. So I'm perfectly fine with this. But if you want to push your proximal to the high of this candle, that can also be done. But again, a beautiful example, though very rare case, but a beautiful example where you can see that whenever you're using any of these indicators, don't use them as your decision making tools, use them as your support tools. And based on your experience, then you should be making your decision whether you want to make some tweaks, or you still want to stick with whatever the indicator is exactly marking for you. Now, these will be rare case scenarios, but yes, you will have such scenarios, because you need to understand what will happen in the future. The indicator does not know at this point of time. So it can only compare with what has happened in the recent past. And what has happened in the recent past, based on that, it understands that this candle is not a very narrow range compared to most of these candles. It is in fact a little bigger, due to which it is taking it as a leg out. But once this happened, now we understand that if I want to take it as a basing, I can still take it as a basing. So that is why I said it's also a very beautiful example for a few things to understand when we are doing our analysis. All right, so coming back to these conditions, we have already looked into these conditions. Now what we need to do next is we need to apply the boosters. So let's apply the boosters. The very first one is freshness. The zone, oops, just give me a second. The zone is definitely fresh. We'll give it a score of 3. Talking about strength, we have an explosive candle. Time at the zone, only 2 candles. Reward to risk ratio, we are taking as an assumption. Location, now this is where we again have something new to look into. Now, we have had such cases in the past where we were having demand areas, but we were not having supplies. So that is the time I talked about 2 options available. Option number 1, you simply skip the symbol because you don't have a demand area or a supply area to do your curve analysis. You move on to the next symbol and do your analysis. And the other option is we can improvise, where we can use the most recent pivot low and the pivot high as the reference point, right? In other cases, we were having demand, so we were using the pivot high as the reference point. In this case, we'll take both these as the reference point. So that's my recent pivot low, that's my recent pivot high. And based on that, we can see we are planning our trade at low of the curve location. So low of the curve is definitely a good location, gets a score of 1. And talking about the trend, you will see that the indicator will tell us we are in a sideways trend, because we have 1 demand violation, 1 supply violation, gets a score of 0.5. Moving on to move from the zone, we already have a move which is more than 4:1, gets a score of 2. It's not a case of level on top of level, but definitely a coinciding level. And I also talked about that the lower zone can work like a trap, and that is also one of the reason why I would like to shift to the lower one versus looking at the one above. So if you look at the overall scoring, we have a score of 10 out of 10 with the assumption of reward to risk ratio, making it as a high quality zone, and 5.5 out of 8, making it as a high probability zone. And high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this can be traded as a type 1 trade. Now, no matter how high the quality or the probability, like always say, any trade can be a stopped out trade. So we need to be ready for the worst case scenario, for which we'll do our position size calculation. Whenever the prices are back, we'll have to re-verify, because the markets are not static. They are changing almost every other second. So we'll have to verify, does it still qualify based on my trade plan? If the answer is yes, you place your order based on the entry type. And the last step is your trade management, which we are also looking at as our example, which was example number 30 from the 4th of August, right? So what we do is fun. At 1:1, we make it as a break-even trade. After that, if we get the opportunity to trail onto it, we start using our trailing stop loss, and that is how we plan trades in a very mechanical and rule-based way. So that takes care of our today's example. And before I get into the questions, queries I have in the Q&A tab, let me add, if you are not subscribed to my channel, do ensure you subscribe to it so that you get notified whenever I'm doing these sessions. And yes, if you're liking these sessions and these sessions are helping you, do hit the thumbs up button, like the video, and also share it with your friends, family members who are into trading, or if you're into some trading groups, you can share with the fellow traders, because I know a lot of people might get benefited out of it. So let's see, what do we have in the chat box? All right. So I appreciate the fact that you are not cherry picking trades, but showing that every trade can be a stopped out trade, stressing that on not every trade will be absolutely. And that is what I do. I like to be as transparent as possible. So irrespective whether it is a stopped out trade, whether it worked in our favor, whether it didn't work in our favor, whatever gets triggered, I always share it with you. The only ones which have not yet been shared will be the ones which are not yet triggered, right? Otherwise, whatever is getting triggered, I always share. And that is what I like to do, so that you people also understand that there is no such strategy which will give you profitable trades on each and every trade. You will have your winners, you'll have your losers, you'll have to accept both of them. But as long as your reward to risk ratios are in place, you can be a net profitable trader. Okay, so I'm having an issue filtering the signals when I get them in TradingView. I am copying and pasting them into the spreadsheet, but I am not able to get clear filters by zones. See, that is not going to help, and the reason for that is because the Excel sheet, the alert filter sheet, which was created, is basically created for the alerts that you get from our Telegram channel, right? It is not created for the alerts which you're placing by yourself on TradingView. So what you need to do is, if you're copy pasting those alerts from your email to an Excel sheet, then you'll have to create your own filters. The one which we have provided is specifically for the alerts which you get via our Telegram channel, right? It's not going to work for your emails. All right, so you're doing a great job by educating traders. All right, thank you so much, Mohan. I hope that's also helping you. All right, can we have this PPT? You mean the rule book, right? Because I think that is what you're talking about. Because if you talk about the PPT doesn't have anything. I think you are talking about this flow chart and this rule book, and both are available for downloads. So like already said at the starting of the session, whatever documents or videos I'm talking about, you can freely access them. The links are available in the description. You'll be able to download this PDF. So it's a PDF, not a PPT, right? So you can download it. Any guidelines as to when it is proper to use refining time frame when evaluating trading opportunity? See, like I said, generally your refining time frame, most of the times it is used when you're trying to do your type 2 type 3 entries, like I showed you today's example, which was session number 25, where we had to wait for a bullish candle, and we did have that bullish candle on the refining time frame. So that is where most of the times you'll be using your refining time frame. Now other cases can be at times, what might happen is, on the lower time frame your zone might be very wide, and that is where you might want to fine tune it, going to a refining time frame and checking, right, do we have any other zone inside of it, due to which I can probably push my proximal line a little deeper into the zone, making the zone a little narrower. That is another place where it can help you. Plus, at times when we are applying some additional rules, that is also where the refining time frame can help us. All right, so okay, so I think you've also answered, Mohan, where to get the PDF from. The alerts and the screener are great time saving tools, not to say that it will help you select the best trading candidates to open position if they meet your see, again, absolutely yes, because like I said, they are not call giving or tip giving services, but what we need as a demand and supply trader is where are the symbols where we have formation of demand and supply areas, and those are the two tools which can help you with that. And that saves a lot of time, helps you only filter out the symbols where you're almost closer to those demand areas and supply areas, thus increasing your probability of finding a good trading opportunity. Though, like I said, every trade, I mean, whatever it is, shortlisting cannot be traded, but at least wasting your time on symbols where you don't have anything versus analyzing only the ones where you do have something available is definitely a time saver. All right. I watched your old alert video and I got aha moment. It shed light on how to work backwards from lower time frame to higher time frame trading purpose. Brilliant, thank you. Okay, yes. So I do keep taking different sessions. I used to take different sessions which were also inclined towards education. Now these are also inclined towards education, but now we are getting much more deeper into doing the analysis versus other things. But yes, these tools can be used in multiple ways, which can help you filter out symbols, even a smaller list. So yes, probably some old video where I might have talked about, maybe you can first start with maybe you're a person who just wants to trade the best location. So first you can filter out the symbols which are only trading at the best locations. Now, once you have that list, then you can probably go to a smaller time frame, your lower time frame, and then identify only the ones where you have formation of zones, which further helps you, do a second filter and get even a smaller list. Or it's struggling to comprehend the logic on how a zone that does not have any applicable condition, that is level on top of level gap, etc., can still be considered qualified for the purpose of applying boosters. See, again, when you talk about level on top of level gaps and all those things, it's not mandatory that they need to be applicable, right? So what we are trying to do is, let's say if it is a case of level on top of level, it gets a little extra probability. If it is a gap, then we want to ensure that it is a pro gap, right? It's not that every zone has to be a zone with a gap. So understand this, that what conditions we have given here, every condition might not be applicable, and the conditions which are applicable, we need to check based on the rules of those conditions, does it get qualified or not. So what I'm trying to you know un- understand from your query is that, Eric, probably you have just started maybe learning demand supply methodology. So the good news is that we already have an archive now where we have already done around 32 sessions for this year. So you can go through multiple sessions. The more number of sessions you'll be going through, you'll start having better understanding. Trust me, just one or two videos or one or two examples, they don't help. So the more number of examples you'll see, the better you'll start having understanding of all these concepts. But again, it's not necessary that all these things should be applicable. We are just checking if they are applicable. Do they qualify based on the rules of the, let's say, pivot non authenticity or unstable equilibrium or gap, to have that extra probability stacked in our favor. I hope that as I continue to attend your live sessions, the confidence level and the understanding of the methodology will continue to see. Absolutely. But again, there will be only a certain level until which it will grow, because see, when you start let's say if you have a graph, you're starting from almost zero, and then you keep going up where you understand the complete methodology. Now once you have understood the methodology, you're flat. Why? Because there is nothing new to learn. Whatever was there, that was your learning curve, and you have learned everything. And then what is going to happen, then these sessions will start getting boring for you. And I think I've talked about this some time ago as well, that once you reach that uh, boring period, that these sessions are now boring for you, that helps you understand that you have understood the complete methodology. Now there is nothing new to learn. But as long as almost every other session you're feeling that there is something new to learn, you can always continue with these sessions. But even if it starts getting boring for you, the advantage of still attending the sessions will be that everything, it keeps getting reinforced, right? So that is another advantage you get. But yes, you'll have that learning curve, after which most of these sessions will be boring, and that is when you realize, okay, I have understood the complete thing. Now there is nothing left for me to understand as far as demand supply is concerned. All right, so continued. It seems there's never an instance where the conditions actually disqualify the zone. Please help us understand the logic. See, the reason why there is never an instance, I mean, there might be, but very, very rare. And the reason for that is because when I'm picking some examples for you, I can't pick examples which are disqualified examples, right? So whatever was disqualified has already been filtered out. And now I'm only picking something which can be qualified and given, I mean, shown to you as an example for these practical sessions. So now if I give you my example, on NSE we have over 2000 plus companies listed. Out of those 2000 plus companies, I'm selecting one for you. So if you think about it, 1999, um I mean, not 1999 has been disqualified. Out of these 2000, probably it would have given me a list of 4 or 5 for that particular day, and out of those 4 and 5, I just share one with you, right? So that is how it goes. But yes, something which has already been disqualified is already filtered out, and that is the reason in these sessions, whatever I'm sharing with you would be qualified. Yes, there will be instances where they might be disqualified when I'm trying to show you certain examples. But yes, most of the times I'm only sharing the qualified opportunities with you. Are it possible to see the ES1 chart? See, again, in these sessions, we are not getting into the specifics of what symbol we are analyzing. And the reason for that is, I don't like to give ready-made trades. Even the ones which I'm sharing, I'm never telling you the name of the symbol because um, one, I don't want to give you fish. I want to teach you how to fish. That is reason number one. Two, when the symbol name is hidden, nobody knows what I'm analyzing. Yes, I do talk about this is NSE, but this could be gold, this could be silver, this could be forex, this could be crypto, this could be ES, right? This could be anything, right? And plus, when you don't know the symbols, you're again, it becomes an equal place for everyone, irrespective whether you're trading the Indian markets or the US markets. And the methodology is definitely universal, can be applied to any market, any asset class, any style of trading you wish to do. All right, so great piece of advice. Learn how to use the tools and rules wisely. Don't just plow ahead blindly without fully understanding. Absolutely, right? Absolutely. So due to your name logo on the left hand top corner, we are not able to snare. So again, that is done by purpose, Mohan, that I hide the name of the symbol. And I just gave you the reason why I hide it on purpose. Reason number one, again, the primary reason is I don't want to give you ready-made trades, and that is the reason I'm hiding the name of the symbols. But when we do the reviews, again, the name is hidden, but you can always match the charts. You will see the charts are exactly the same. It's just that more price action would have happened. But yes, that is how I like to keep these sessions, not disclosing the name of the symbols. Okay, so I've just answered that query. Thanks for the clarification regarding the filter spreadsheet. I will use it. All right, perfect. Uh, yes, you are right. The learning curve will plateau, but you will always pick up some nuggets along the way that will make absolutely. And that is what I was talking about. I guess I also talked about this some time ago. That probably 20, 25 lessons, 30 lessons, 50 lessons, maybe 100 lessons, you might be picking something new almost every other session. But beyond that, you will see that now everything is covered, right? So that curve is probably maybe 50 sessions, 100 sessions, maybe 200 sessions. But after that, there'll be nothing new, right? Because if you look into it, there are only few things we are always looking into, right? There are not n number of things or thousand things we are looking into. At the end of the day, it's probably 10, 12, 20 things we are always looking into. And that is where things will start getting boring eventually. Okay, so I love your honesty, teaching us how to fish rather than giving the fish to eat. Teaching will last for a lifetime, rather. Absolutely. Thanks for the clarification. Qualified zones. Yes, I'm just beginning my journey. I was tipped by session number 16 where no conditions were present and it was up. Perfect. So that is what I was talking about, right? There can be cases where none of these conditions are applicable. So what we are only trying to do is if any of these conditions are applicable, do the zone get qualified because of those conditions? If they are not applicable, then by default the zone is qualified, right? So I hope that helps in understanding. But like I said, the more number of sessions you'll be watching, you'll start having better clarity to it. And that is why I always try to take these sessions once every weekend. But again, I'll add, like I already said at the starting of the session, next weekend I'm not available. Be that Friday, Saturday, Sunday, I'm not available on any of these 3 days, which is why I would not be able to take a session during the next weekend. But after that, we'll again be regular with these sessions. So I just wanted to uh, you know uh, update you guys so that in case you want to plan something, because I know some of you might be taking out time specifically for these sessions to attend live, because that is where you can also ask your questions, queries. But yes, if you have now something important, you can plan it for the next weekend since I'll not be available. So again, thank you everyone for joining in. I'll be seeing you now next to next weekend. Till then, trade safe, enjoy your Sunday, take care, bye bye.